New Holdings just reported a staggering 53% revenue surge. They added 4 million new customers in a single quarter. And yet, the stock absolutely tanked. We are staring at one of the most glaring valuation disconnects in the market right now. The headlines have been screaming about missed earnings and massive credit provisions, which triggered this rapid sell-off. But if you actually look under the hood of these financial statements, you don't find a broken company. You find a highly misunderstood economic engine that is actively disrupting the traditional banking oligopoly across Latin America.
Which brings us to the massive tension dividing Wall Street right now. Is the market completely wrong about New? Today, we're going to break down the surface-level panic that caused this sell-off and contrast it directly with the underlying reality of their balance sheet. Because as you'll see, what looks like massive risk to short-term algorithmic traders is actually just the mathematical byproduct of hypergrowth.
And nothing illustrates this reality better than this number right here, 17.6%. That is New's consolidated efficiency ratio as of the first quarter of 2026. Now, if you follow banking, you know that number is just absurdly low. Legacy banks in Latin America typically operate with efficiency ratios hovering somewhere between 40 and 55%. They can't even dream of touching 17.6%. This one single metric is the ultimate proof point of New's operational dominance. It proves they can scale their digital-first infrastructure way more profitably than any traditional incumbent out there.
The market's massive mistake, the $1.79 billion illusion, and the CFO panic.
Look, to fully grasp the opportunity here, we first have to understand the fear. This recent sell-off wasn't just random. It was triggered by a very specific set of numbers and executive movements that, on the surface, looked like a severe warning sign. The panic kicked off on May 14, 2026, when New dropped its Q1 financial results. Let's look at reality versus expectations. The company reported a massive 52.97% year-over-year revenue expansion, hitting $4.97 billion. Sounds great, right? But Wall Street consensus was looking for something slightly higher, closer to $5.08 billion. Net income surged over 56% year-over-year to $871.4 million, but analysts wanted $927.7 million. And diluted earnings per share came in at just under 18 cents, missing the 19.5-cent consensus. In today's market environment, even a slight miss on aggressive consensus estimates sparks immediate punishment.
But honestly, the earnings miss was just the match. These right here are the actual bear case triggers that poured gasoline on the fire. First, their credit loss allowance jumped 33% sequentially to a whopping $1.79 billion. This caused their risk-adjusted net interest margin to contract by 100 basis points down to 9.5%, basically meaning the core profitability of their loans shrank slightly on paper. Then, right at this critical expansion juncture, they announced a major CFO transition. Guilherme Lago was out, and Rob Livingston, the former Visa North America CFO, was coming in. So you combine margin compression, elevated credit provisioning, and a sudden executive shuffle, Wall Street panicked. This led to immediate downgrades, most notably Bank of America cutting New to underperform at the $10 price target.
Section 2. Inside the economic engine, structurally superior digital banking.
Okay, so now we know what the market fears. But to really see the disconnect, we need a crisp understanding of their actual economic engine. Because guys, this is not your typical regional bank. Noah operates a pure-play, cloud-native digital platform. They completely bypass the heavy real estate and human capital overheads that drag down legacy banks. This creates a formidable, multi-dimensional moat built on 5 core pillars. First, that unmatched structural cost advantage we just talked about. Second, they're fueled by a $42.4 billion low-cost retail deposit engine, which totally shields them from wholesale funding volatility. Third, they have a proprietary transaction data flywheel trained on 135 million active users, allowing their AI model, which they call Newformer, to underwrite credit with extreme precision. Fourth, incredibly high customer satisfaction drives unpaid organic referral growth. Their customer acquisition cost is practically zero. And fifth, once customers start using New for salaries, payments, and insurance, the ecosystem switching costs become massively high.
So, the crucial takeaway here is this brutal mathematical reality facing traditional competitors like Itaú, Bradesco, and Santander. Check this out. New's monthly servicing cost is approximately 80 to 90 cents per active customer. Let that sink in for a second. Under $1 to service a customer for an entire month. Traditional banks simply cannot replicate this ultra-low servicing cost without destroying their own balance sheets by writing down massive physical branch networks. New is structurally superior by design.
And here is how that incredible engine translates across their total addressable market. Brazil is the mature core. It represents about 62% of consolidated revenues with over 115 million customers. That practically covers 62% of the entire adult population there. But the real high-growth runway, that is happening right now in Mexico, where they just crossed 15 million customers, and in their early expansion phase in Colombia. The profit pool in these underbanked regions is absolutely massive, and Nu is systematically capturing it. And by the way, if this kind of research-first analysis is your thing, you'll probably want to subscribe.
Now, all of the research behind this video was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. But if you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, which are quality businesses built to compound for years; hidden gems, those under-the-radar names with asymmetric upside; and dividend hunters, offering durable income with the fundamentals to back it up. You also get Portfolio Watch, which monitors your portfolio and flags important changes, plus Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
Section 3. The hard evidence. How hypergrowth masks as risk.
Shifting over to the specific evidence that dismantles the bear case, we really need to focus on the accounting mechanics and the real-world milestones that Wall Street algorithms completely misread in that Q1 report. Because the great misunderstanding of the entire quarter lies right here, IFRS 9 accounting. Remember that 33% jump in credit loss allowances that totally terrified the market? Well, it was largely an accounting illusion driven by this international reporting standard. Under IFRS 9, Nu is required to take an immediate upfront provision for the lifetime expected credit loss the very second a new loan is booked. CEO David Velez explicitly clarified that 86% of that $800 million increase in credit provisions was purely driven by massive portfolio growth and normal seasonality. It was not a sudden deterioration in credit quality. Literally, they are being penalized on paper for growing their loan book too fast.
And to give you total peace of mind on their balance sheet, just look at this coverage metric. 16.2%. This is Nu's total credit portfolio coverage ratio. Because of that massive upfront provisioning required by IFRS 9, they've built a buffer that is roughly 2.5 times their outstanding 90-plus day delinquent balance. They are heavily over-provisioned relative to actual long-term defaults.
And right as the market was doubting them, they dropped a massive catalyst in July 2026. New Mexico officially secured full multiple bank operations authorization from the Mexican banking regulator. This is a game changer. It transitions them from a limited entity to a full-service banking institution. It instantly unlocks 16 times greater deposit insurance, larger deposit limits, and a massively expanded lending suite. And they are backing this up with a $4.2 billion capital investment plan through 2030. This completely reshapes their total addressable market in a country of 130 million people.
Section 4. The 5-year scenarios. Modeling the mathematical outcomes.
So, knowing the actual state of the business, where does this leave the valuation? Before we model exactly where the stock could be by 2031, I need to be perfectly clear. This is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios.
Let's break down the underlying operational assumptions that drive these 3 distinct cases over the next 5 years. In our base case, which we assign a 60% probability, Nu continues its dominance in Brazil while successfully scaling in Mexico and Colombia. Under this scenario, by 2031, revenue hits $57.3 billion. Margins expand to 23% as higher margin credit cohorts mature. If we apply a reasonable 22 times exit PE multiple and factor in ongoing share buybacks lowering the share count to 4.8 billion, we see some really steady compounding. Now for the high case, at a 25% probability. This assumes seamless execution. Their AI Nuformer underwriting engine allows them to aggressively expand credit limits safely, and an early U.S. operational launch targets the highly lucrative remittance corridor. Here, revenue surges to $73.68 billion, margins hit 27% thanks to AI automation, and they command a 28 times PE multiple. Finally, the low case, sitting at 15% probability. This is anchored by a structural credit crisis in Brazil, severe currency depreciation, and strict regulatory margin compression. Revenue growth stalls out, reaching only $32 billion.
Margins compress to 14%, and the market slaps them with a legacy bank multiple of 12 times earnings, while share counts inflate.
And here's the math payoff. From a mid-2026 starting price of $14.33, the low case drops the stock to $10.67. That's a negative 5.7% annualized return. The base case drives the price to $60.40, representing a massive 33.3% annualized return, and the high case? That sends it soaring to $119.79, a near 53% annualized gain. When you probability weight these outcomes, you arrive at a blended 5-year target price of $67.80. This asymmetrical upside is heavily driven by their immense 29% return on equity compounding over time. And hey, if you want to access the full model with all the detailed assumptions for each of these scenarios, you can check out the detailed research report over at Flash.
Section 5. Risks and Reality. What could actually break the thesis?
All right, bringing the narrative back to earth, we absolutely must evaluate the threats that could permanently impair these massive growth targets, because ignoring risk is how investors get wiped out. We don't want to deal with vague fears, we need concrete, trackable metrics. So here is exactly what you should watch out for in upcoming quarterly reports. First, a cyclical asset quality deterioration in Brazil. Nu is heavily dependent on the Brazilian consumer credit market. If local inflation spikes, you'll want to see if the 15 to 90-day non-performing loan ratio breaks decisively above its typical 5% seasonal trend. Second, the Mexican expansion could stall. If New Mexico fails to successfully transition customers into high-yield credit products, you will see the average revenue per active customer, or ARPEC, completely flatten out while deposit funding costs rise relative to interbank rates. Finally, a U.S. expansion drag. Going into the U.S. market involves immense regulatory compliance. If this goes poorly, the early warning sign will be Nu's consolidated efficiency ratio permanently breaking above their target 20% ceiling.
But if we look at the current real-world asset quality as of Q1, the reality actually remains incredibly stable. Yes, the leading 15 to 90-day short-term delinquencies ticked up to 5%, but management confirmed this is perfectly consistent with typical Q1 consumer delinquency seasonality. Meanwhile, the lagging 90-plus day long-term default ratio actually improves sequentially by 10 basis points down to 6.5%. That is comfortably below its historical peak of 7%. So the credit book is holding up exactly as designed.
Section 6. Scorecard and Final Synthesis. The 8.6 out of 10 Disruptive Compounder. Synthesizing all of this, Nu earns that 8.6 out of 10 blended score because they combine a perfect 10 out of 10 track record with exceptional capital allocation. While analyst sentiment is currently a bit mixed due to short-term margin concerns, the underlying business quality is just undeniable. Here are the 3 most vital takeaways that prove why this recent sell-off was a fundamental misread by the market. Number 1, the Q1 panic over credit loss allowances was largely an IFRS 9 accounting illusion driven by exceptional loan growth, not failing credit quality. Number 2, securing a full banking charter in Mexico instantly unlocks a massive new total addressable market, allowing them to rapidly scale deposits and high-yield loans. And number 3, the board authorizing Nu's first-ever $1 billion share repurchase program proves management's absolute conviction in their cash flow generation and the current valuation disconnect.
The data tells a very clear story here. Nu Holdings is a high-conviction compounder trading at a massive discount relative to its earnings growth potential. They have built an economic engine that legacy banks simply cannot compete with on a structural level. The math is clear, but the ultimate question remains, will Wall Street wake up to the reality of this economic engine before Nu completely captures the rest of Latin America? If you want the full research, including the deeper framework behind this video, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.